Welcome to On the Investor's Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. So in this episode, I want to walk through two very hot topics, the Fed Chair nominee Kevin Warsh and also volatilities we've seen in precious metals such as gold and silver. So let's start with the Fed Chair. On the 30th of January, President Trump named Kevin Warsh as his nominee for the Federal Reserve Chair. Warsh is known for a hawkish tilt from his time as a Fed governor between 2006 and 2011. After leaving the central bank, he has criticized the Fed for straying beyond its mandate, including enabling fiscal excesses via QE. More recently, though, he's been arguing the Fed should cut rates more aggressively. For now, the growth, inflation, and liquidity outlook for the US economy does not really provide much support for substantial easing. Also, institutionally, the Fed Chair must build consensus. So multiple near-term cuts will require the Fed Chair, Kevin Warsh in this case, to persuade a majority of FOMC members to agree with him, and this is going to be quite challenging given where we are in the economic cycle. So let's quickly run through the macro checklist. On growth, real GDP ran hot, 3.8% annualized in Q2 of last year and 4.4% in Q3. We are going to get the Q4 numbers soon, but initial indications suggest that it's going to be a strong number. Consumption, which is roughly 68% of GDP, grew at about 3% in Q4. Now, even with some cooling, growth could re-accelerate in the first half of 2026 as income tax rebates and potential tariff rebate checks can boost household cash flows. Also, the wealth effects from a more than 3-year equity bull market and also the ongoing AI-related capex are additional support for economic growth. When it comes to the job market, net job creation has averaged just 15,000 jobs per month since last June. And this could be revised lower. But weak hiring does not necessarily mean a weak economy if labor supply is also shrinking, which means companies may want to hire, but they're not really able to find people to fill those jobs. Weekly jobless claims have trended lower, unemployment rate has been holding at 4.4% in December, and also new population projections implying that working age population may be declining modestly. That is a structural shift that monetary policy cannot easily fix. On inflation, the Fed's estimates for December's core personal consumption expenditure is 3% year over year, the highest since last February, and this could drift higher towards 3.5% by mid-year if the refund-driven demand allow retailers to pass through more on the tariff costs. Now, while inflation may fade in the second half of 2026, today's mix of unemployment rate near the Fed's 4.2% goal and inflation well above 2% does not really ask for aggressive easing. So on balance, even with the pending leadership change at the Fed, the landscape argues for a more neutral Fed stance in the near term and also with a higher bar for multiple cuts, barring a meaningful growth slowdown or a faster than expected slowdown in inflation. Now, we do think the Fed Chair nominee will base his decision on incoming data. His call for lower rates is partly built on productivity growth driven by the development of artificial intelligence, which isn't something that we can easily observe in the near term. Hence, we see the futures market now currently pricing in only 2 cuts before the end of the year to be quite reasonable. Now let's move on to precious metals, where fundamentals and positioning have led to quite significant volatilities. Gold and silver went through some wild swings in the past week. After hitting the high of $5,585 for gold, which is obviously a record high, it fell over $1,000 in 3 days and now just back above $5,000 mark. Now, this bout of volatility reiterated a few key points we've been making for the past couple of years. On the positive side, gold remains well supported by investors' demand. Central banks continues to be a key pillar of support as they continue to diversify their foreign exchange allocation. And investors are following not only the central banks, but also their concerns over the risk of poor fiscal discipline leading to excessive issuance of debt and also money. With limited room for growth in production for gold, silver, and copper, these metals are seen as better ways to retain value and fight financial repression. However, Gold is also inherently volatile with no income generated. This volatility could be exacerbated by an increase in retail participation as well. Hence, investors will need to be disciplined in sizing their allocation appropriately. Why we discuss the Fed and metals together? So why do we put the Fed chair nomination and the metals market together? Because liquidity, real economy, and concerns over fiscal disciplines, all of these are impacting on the metals market. Gold is seen as a hedge against the risk of the Fed losing its independence as well, although we think that's actually less likely now given the composition of FOMC members. And also for a Fed that stays closer to neutral while growth remains decent can keep real yields range-bound, and this could temper gold's appeal in the near term to some extent. But in the longer run, we still see the benefits of having gold and copper in portfolio as a way to diversify. So thanks for listening. If you enjoyed this podcast, please share this with your friends and colleagues, and of course, consider subscribing. If you have topics that you want us to cover in the future, please reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui, and I'll see you in our next episode to discuss what's on investors' minds. And meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.